Hello, it's Brian Shannon from AlphaTrends.net. Today is Monday, July 12th, 2010. Let's take a look at this S&P 500. As we know, last week we had a strong bounce on light volume, but it was a four-day week as well. But prices were significantly higher last week, and as the market bounced from that 38.2% retracement of the rally from the March lows to the recent highs. So it came down to that 38.2% retracement, and so far it's bouncing. That level was also significant, as we know, because it was approximately the volume weighted average price since the March lows of last year. So that adds to the importance of that 101 area, basically. And right now we look at it, and the market's bouncing, so we have to respect that. Then look at the daily time frame and see what kind of clues we can find there. Here in the daily time frame, I've just got a 10, 20, and 50-day moving average. It's had a little bit of trouble with the 20-day moving average the last couple days after this significant bounce. And what's most notable here, I think, is that the volume is really diminishing once again on a rally. And that leaves us to look at this market and say, what's most likely? Well, we have a declining 50-day moving average. So when the 50-day moving average is declining, you generally look at the rallies on the daily time frame as something that is likely to fail. Throw on top of that the fact that we have diminished volume. It shows there's less conviction behind this buying, maybe just an absence of supply that's coming into this market, and those rallies are typically more likely to fail. And it occurs, again, below the declining 50-day moving average, but also we look at this market and say, well, it looks like this has the potential to become another lower high within this downtrend we're in. So does that mean we sell short right here, right now? Unfortunately, it's just not that simple. We have to still consider other time frames. And looking at the 30-minute time frame, you can see here that I've got these Fibonacci lines drawn and we've been looking at for the last week or so. And that's based off the June highs to the lows that we'd seen on July 1st. So far, we've retraced a little bit more than 50% of that move, and the market is back above that rising 5-day moving average. We can also take a look again at the volume weighted average price since this high, and we can see the average participant is involved in the market down at 106-ish area. So whether you're long or short over the last, since June 21st, the average price the SPY is traded at has been about 106. So generally you look at that and think that the buyers have gained control, at least since June 21st, and the short sellers who've put on positions here over the last couple of weeks are in a losing position. So where do the sellers regain control? Well, again, taking a look at that volume weighted average price, if it's to break that back down below 106, the average participant would then be long participant would be in a losing position, and I think the shorts will get more aggressive on the downside. So that's going to be an important level to keep an eye on. We also have this rising 5-day moving average. So while we have a declining 50-day moving average, that tells us on the daily time frame be suspicious of rallies, and they're more likely to fail than to follow through. But they can follow through, and we don't want to get short until the shorter term time frame, such as the 30-minute here, starts to show some weakness. And right now, it's just not doing that. We have today we'd seen a pullback down to this prior resistance that had become support last week. So 107 is our first line of defense for this market. If it breaks 107, then we'll probably come down towards about this 106.60 area, and then that 106 level is going to be really the key, because again, that's approximately the volume weighted average price since this sell-off and subsequent rally began. Now, the Fibonacci tells us that this rally is getting a little bit extended, that normally in a downtrend that the rallies will fail somewhere around that 61.8% retracement level. But the market is in this watch and wait mode while we have earnings coming out, and that's going to be really the key here, is to managing risk on individual stocks. And when if the market, and it seems most likely that the market at some point here in the next 2 to maybe 8 days does turn back lower and we get another leg lower again. And if that's the case, then you obviously want to be focusing more on the short side opportunities and looking for stocks that have rallied in a similar fashion, that is up to a maybe significant moving average on lighter volume, and then as it begins to turn lower on the shorter term time frame, such as the 10-minute time frame here, and we see this pattern, which is now a pattern of higher highs and higher lows. Once we see that start to turn sideways and then break those important support levels, that's the time to start focusing on the short term. So for now, it doesn't seem as though the advantage is to be short, and you got to be a little bit crazy, I think, to be an aggressive buyer here after such a strong percentage bounce on light volume in an overall declining market.